Ladies and gentlemen, welcome back from the summer break to our Basel IV YouTube channel. I don't know how it's about you, but I enjoyed my summer holidays a lot, even when from the regulatory perspective there was a lot of movement. The first thing that we would like to cover in our first episode of the YouTube channel after the summer is the report that the EBA was publishing, first on the quantitative impact of Basel IV on the European banks, and on the other hand giving some recommendation to the EU Commission on how to implement Basel IV inside the EU, the European Union. I have again an expert by my side. Today it's Stefan. Hi Stefan.
Hey Martin.
Would you like to introduce yourself?
My name is Stefan Röder. I'm a senior manager in the Regulatory Management Division here at PwC.
Stefan, we were working now on Basel IV for almost 1.5 years. Together we were doing quite a number of impact analysis, supporting banks in calculating the new risk-weighted assets for the standardized approach for credit risk, for the IB approach, for the capital floor, CVA risk capital charge. And now the EBA comes and publishes their own quantitative impact study. First question in your direction, what is actually the finding? What is the result of the EBA?
Well, I think three main facts stand out, and most of them corroborate what we have been telling based on our own impact studies. So let's start with the overall impact of Basel III, and here the numbers that the EBA has published are quite impressive. So they expect an increase in risk-weighted assets of 24%, or to put it as an additional total capital requirement, a massive 135 billion euros of additional capital that banks will need to hold in the future.
Mm-hmm. Yeah, 24%, that is definitely impressive, but maybe also a little bit misleading, because the EBA speaks of total impact on risk-weighted assets of 24%. But of course, there were more than 180 banks participating in the QIS in Europe. What does that mean actually?
Well, as always, these average numbers hide as much as they are revealing. So for example, the EBA itself says that the results are driven mainly by the large international banks, and gives some additional numbers for medium-sized banks where the impact is more around 10% of risk-weighted assets, or small banks where the impact is even lower with around 5% of risk-weighted assets.
Mm-hmm. Stefan, when we make a differentiation between large banks, medium banks and small banks, you said already before that the biggest increase is by far for the large internationally active banks, here especially driven by the capital floor, so banks that are using internal models for the calculation of risk-weighted assets will have a quite high increase. But when we look to the mid-sized banks and the smaller banks, where do you think, where comes the impact from, and how big is the impact actually?
Yeah, I think the main driver for the risk-weighted assets increase, especially in the small banks, is obviously the standardized approach for credit risk. Because here in the EU, most banks are still driven very much by credit risk, and there is a number of exposure classes in the standardized approach that are really massively impacted by the finalized Basel III reforms. Maybe we can have a look at that in more detail later on.
Yeah. Based on the EBA, the impact for the small banks is around 5% increase in risk-weighted assets. Nevertheless, the EBA mentions also that there might be also banks that can decrease their risk-weighted assets. Based on the impact analysis that we were doing, I think we can support the EBA in their findings, but I would even go one step more or farther, because we have seen banks that are actually able to reduce their risk-weighted assets by 10%, by 15%, of course highly depending on the kind of business they are doing, how conservative they are, because actually all the new approaches for the calculation of risk-weighted assets, they are more risk-sensitive, so when a bank is very conservative, the risk weights go down. But on the other hand, also for the standardized approach banks, we have seen results where banks have to face an increase of up to 20-30%. what are the main drivers there? Can you give an example maybe?
Yes, sure. And now we need to go through all of the exposure classes one by one, and the first exposure classes that we would look at and where we can see an impressive increase in risk-weighted assets are, for example, exposures against banks or equity and subordinated debt.
Of course, equity exposure, subordinated debt, that is not the biggest part of the portfolios. Nevertheless, what we have realized is that the identification of these kind of positions might be quite burdensome because currently the risk weights are pretty much the same, no matter if you have a normal corporate loan, if it's subordinated, or if you have an equity exposure. So therefore the data quality is also not the best. So that's definitely also a finding that we had, that the results that were sent to the EBA or to the Basel Committee for the QIS purpose is sometimes not the best one, because banks were simply not able to identify all positions that fall under the new rules. But moving to the next exposure class, what about bank exposures? Do you see there any kind of impacts?
Yes, we see a really huge impact when we are looking at unrated bank exposures, where currently the risk weights are derived from the country in which the institution is situated, and this rule will be scrapped, and there will be at least a doubling of risk-weighted assets for large amounts of the interbank exposures. On the other hand, the EBA was quite vocally that existing exemptions for institutional protection schemes should be kept, and we know that this is a quite politicized topic, and therefore it's interesting that the EBA is situating itself quite clearly in this respect.
Yeah, thank you very much, Stefan. I mean, bank exposures are a perfect example to describe an effect that we have seen also, that the impact of Basel IV does not only depend on the business model, but also on the country a bank is located in, and also how the banking market is organized. For example, in Germany we have a highly fractured banking market with a lot of small banks, normally unrated, so there we will definitely see a quite significant increase in the risk weights. But on the other hand, we have banking markets like in France or in Spain that are highly concentrated, and all banks have actually an external rating, and for them the risk weights are actually not changing, or even in some cases reduced. Another exposure class that might have quite a big impact is corporate. Stefan, what's your experience here, and what does the EBA say?
Well, with regards to corporates, there are a couple of interesting points. For example, the EBA advocates to remain using external ratings, which comes as no big surprise, but is good to have that in written as well. Secondly, they give us some more information about the proposed due diligence process that the Basel Committee has proposed. Thirdly, and just as in the case of the banks that you just mentioned, the risk weights based on external ratings do not change that much, so a lot of the impact finally will depend on the rule that can be found for the SME exposures. And here one of the bigger surprises of the EBA paper is that they recommend to stick really with the Basel rules, which see an 85% risk weight for SMEs in the corporate exposure class, and therefore scrap the existing SME factor in the European Union of 76.19%, which would then add some risk-weighted assets to the portfolios of most banks.
Yeah, that discussion might be very interesting in the future, how it will be actually implemented, because the SME factor in the European Union was just broadened in the CRR2. So if the SME factor will be really skipped out for the 85% coming from the EBA, we will see. Another exposure class that might have a big impact, but in both directions. On the one hand side, a reduction in risk-weighted assets, but also an increase, is mortgages. And here we have to make a differentiation between residential mortgages and commercial real estate mortgages, and another differentiation in income-producing real estate and non-income producing real estate. Stefan, what are your observations here, and what are the observations of the EBA?
Yes, mortgages is really a very interesting exposure class, and as part of our impact studies we have seen basically everything from decline in risk-weighted assets to massive increases depending on the factors that you've just named, like for example residential versus corporate real estate or the general treatment versus income-producing real estate. The EBA report here offers two very interesting insights from my point of view. And the first one is that the EBA clearly states that it has no sympathy for the so-called whole loan approach or LTV approach, but instead opts for the modification of the existing credit splitting approach, which it deems to be more suited to capture the economic substance of collateralization with real estate, and which in most of our own impact studies resulted in lower risk weights than the whole loan approach. So this sounds quite good news for most banks. However, there are some pinches of salt to take along with that statement. Second very interesting thing is the question of how to derive the value of real estate collateral. And the current CRR here always talks about market values on the one hand side and mortgage lending value on the other hand side, but so far the EU is lacking a clear definition of what the mortgage lending value constitutes. There are some countries, Germany for example, with specific rules, but there is no EU-wide rule on that, and therefore one of the interesting parts of the EBA's paper is that they recommend to scrap references to market value and mortgage value, lending value, and instead have an own definition for the purposes of calculating risk-weighted assets on how to calculate the value of real estate collateral. That would then be a common approach in the whole European Union, which I think would be a very good thing to have to address fears that there is no level playing field so far.
As far as I understood, the EBA recommends, but we will see that later in the slides as well, to develop an RTS on that, a regulatory technical standard, and that will be one of the most important ones at all, because the portfolios on mortgages in European banks are the biggest portfolios overall, no matter if it's commercial or if it's residential. And the lending value that goes into the calculation of both the splitting approach and the LTV is, of course, a linear factor. So depending on the value, the risk rate goes up and down. We will come to one point later, again also in the slide, regarding a whole loan approach versus a splitting approach, because there's a very interesting time effect that leads to a switch, like which approach is preferable over time, but to that later. But regarding income-producing real estate, Stefan, I think that's also a quite big challenge for the bank.
Yes, it's a big challenge in regards to 2 points. So first of all, banks need to identify exposures that are income-producing real estate. They never had the requirement to do so far, so it is something new that they will need to find in their systems, and of course for all positions in their portfolios at the point in time when the Basel III rules will need to be complied with. Second thing, of course, is the increase in risk-weighted assets that I've just mentioned. So here we really see a market increase as compared to the current approaches. And what the EBA paper offers here is some news around, first of all, the identification of IP real estate exposures. For example, there is a maximum amount of immovable properties that one person may refinance before he actually starts to be treated as IPRE. So people with only a limited amount of real estate in their portfolio may be exempted from these rules. And second of all, there are some new insights with regards to how to treat portfolio effects. So if I refinance a whole portfolio of real estate properties, and therefore each one of them, if looked at in isolation, would fulfill the IPRE criteria, but all of them do not fulfill them because the portfolio is able to refinance the loan, even though my personal income is not. Here we now have interesting information on whether these types of financing would be counted as IPRE or not.
I think that's a very important point, especially for private persons or wealthy persons that own more than one flat that they are renting to other people. From which number of flats that they are renting, they will be treated as income-producing real estate. I think there will be a lot of discussion around that. Maybe moving away from the standardized approach, a few words also regarding the IRB approach, what the impact there is. And I think we have to make a differentiation here between the impact coming from the parameter changes and also the impact coming from the way on how to consider collaterals in the foundation IRB approach in the future. What have we seen there, Stefan?
Yes, it's indeed quite interesting that the Basel Committee is changing a lot of parameter and formulas with regards to the treatment of collateral in the IRB approach. Overall, our test calculations have always yielded the result that RWA will probably decrease for banks using the foundation IRB approach, but before the application of the capital floor. That is a very, very important statement here. So IRB, RWA in isolation will probably decrease, and the EBA report basically goes along with that and offers no changes or basically advocates to implement the Basel IRB rules as proposed by the Basel Committee.
Now, one important point here is when we talk about collaterals in the IRB approach is the effect of over-collateralization. Currently in the CRR and also in the current Basel regime, it's floored, so under a certain LGD it's not possible to go. But with the new rules, you really can benefit from very high collateral values compared to very low exposures. And of course, over the time, the development is always like this, that the collateral values very limited over time, while the exposure is decreasing more and more when the customer is paying back the loan. The overall impact, the EBA says, might be between 5% up to 10%. That's pretty similar also what we have observed in our detailed impact calculations. There might be some extraordinary circumstances where the impact goes even higher, that banks are able to decrease their risk-weighted assets by up to 15%, but that highly depends on the business model and the type of collaterals they are actually using. When we speak about the scope of application for the IRB approach, of course, we have the exposure classes banks and large corporates, which have to move from advanced IRB to foundation IRB. There is probably an increase in risk-weighted assets, but not so significantly as you might think. There's an increase of up to 5% that we see. And last but not least, it will be not allowed anymore to use the IRB approach for equity exposures. But coming from the IRB approach, we also don't expect so big impacts, because the risk weights in the IRB approach are traditionally already quite high, especially when you use the simple risk weight approach. Only if you use the PD-LGD approach, there might be a significant impact, so that the risk weights go up under the standardized approach. Yeah, two topics are still left, which is operational risk and CVA risk capital charge. Stefan, regarding operational risk, what do we see there in terms of impact?
The impact, obviously, once again, is especially pronounced for the large international active banks that currently use AMA models and will have to stop using them for Pillar 1 capital requirements and switch to the new standardized approach for op risk. Here, the increase in capital requirements is quite pronounced. Apart from that quantitative impact, what the EBA paper is offering are some more insights with regards to the collection of operational risk loss data, which we personally view as the most challenging part of implementing the new standardized approach. And there is also some wording around the use of the so-called internal loss multiplier, which is either 1 for very small banks or needs to be calculated by the banks themselves for the bigger banks. And here the EBA gives us some ideas on when to deviate from these rules. So, for example, when to use a flat number of 1 for bigger banks, or when to require smaller banks to calculate this factor for themselves. So quite interesting reading, but from the impact, not so impressive as what we have seen with regards to credit risk.
Yeah, for sure. And last but not least, CVA risk capital charge.
Yeah.
Are there any effects?
big surprise. There is nothing on the CVA risk capital charge as well as on the market risk part, because these will be covered in a later report by the EBA that we are still very curious to get our hands on, but that hasn't been published yet.
Based on the impact analysis that we have done so far is that it highly depends again on the business model. Banks with high derivative portfolios will definitely see an increase in the risk-weighted assets for the CBA. But as Stefan said, we will see what the EBA will publish in the future. The last topic that I would like to cover now is quickly the capital floor. As you might remember, the capital floor will be calculated by multiplying the risk-weighted assets for the standardized approach with 72.5%, and of course the impact is the higher, the bigger the difference is between standardized approach risk-weighted assets and IRB risk-weighted assets. That is very individual. Stefan, can we at all give an indication on the floor impact? Is that possible, or is that due to the individual situation of each bank not possible?
Well, what we can clearly say is it hurts. That is what is driving the massive increase in risk-weighted assets for the large international banks. They use a lot of internal models, and therefore they are hit strongest by the capital floors, and well, an increase of 24% in risk-weighted assets on average really shows that this will have a huge impact on the banks. However, there is one thing that needs to be considered when we look not only at risk-weighted assets but also on capital requirements, and that is the question of which minimum quota will these increased RWAs be compared with.
Yeah, of course, there is a big discussion currently between supervisors or regulators and the banking industry if the floor impact will be only considered for the minimum capital requirement, which means the Common Equity Tier 1 ratio plus the buffer requirements, but only the conservation buffer and the counter-cyclical buffer, or if it will be applied also on the so-called Pillar 2 requirements, the SREP ratios. The discussion is not finished there. The EBA is quite strict. They say the capital floor should be applied on the SREP ratio. But maybe it could be decreased because with the capital floor the modeling risk will decrease as well, so that it would be okay also to decrease the SREP ratios. Yeah, that's it regarding the quantitative part of the EBA report. Stefan, so far, thank you very much. I would like to thank you for your attention. There will be a second video that is around the qualitative requirements. I hope you watch that one as well. If you have any question regarding the quantitative impact, and if you want to perform a quantitative impact study on your own, we are more than happy to support you. And there will be definitely at least one, if not several other quantitative impact studies by the EBA and the Basel Committee. And there, of course, you also can count on our support. So thank you very much for your attention. I hope to see you later on also in the second video. Bye-bye.